Namaste and welcome back to Smart Credit with Sangeeta, your trusted guide for understanding the secrets to a successful MSME loan approval in India. In today's video, we are diving into one of the most important financial ratios in business loan approval, appraisal, that is the DSCR. If you have ever applied for a term loan or submitted a CMA report, or you have processed a term loan or project loan, you are aware of this term. But what does it actually mean? Why does it matter so much to banks? And how do you calculate it? Grab your chai, pen, and a paper, and let's unravel how DSCR can be your ticket to business growth. So let's learn how to calculate, interpret, and use it confidently. By the way, if you are new here, I am Sangeeta Sharma, a former credit officer with more than 11 years of MSME lending experience. I simplify MSME finance and credit appraisal for credit officers, finance students, and entrepreneurs. So, if you find my video helpful, make sure to like this video, subscribe to my channel, and hit the bell icon because I post financial content every week. And if you have not watched my previous video, I want you to watch my previous video in order to have a better understanding of this video. Most of you have heard in banking from your seniors, पीछे देखो और आगे बढ़ो. Sound familiar, right? But honestly speaking, being from engineering background, it confused me a lot. I didn't get even after seeing the past files. You know why? Because term loan is different, DSCR is different. All the ratios are calculated on the past years, but DSCR is calculated on future projection, and this differentiated from others. If you stay by the end of this video, my aim is to help you understand what is DSCR, its formula, why is depreciation taken into account in the formula, and what is the ideal value of DSCR, and why is interest taken both in numerator and denominator, consequences of low and high DSCR, different industries DSCR benchmark. So what is DSCR? DSCR stands for Debt Service Coverage Ratio. It's a financial tool used by lenders to check if the business can repay the loans. Simply put, DSCR shows how much income a business generates compared to what it owes in the loan repayments each year. Think of it as your business ability to pay its debt. Okay, like checking if you have enough monthly income to pay your EMIs, just like you would not take a EMI of 50,000 if your salary is only 40,000. Even banks won't give loans to businesses that can't comfortably service their debt, right? So what is the formula? Before starting the formula, let's first consider a simple retail loan. What is cutback? How you calculate the cutback? Simple, na? Gross income divided by expenditure. Similar is the case of companies. The formula is beautifully very simple. DSCR is equal to net profit after tax plus depreciation plus interest on term loan divided by your EMI, that is principal repayment plus interest on term loan. This is the standard formula used by banks. Now you might ask why depreciation is taken into account, right? Since all of you know that profit after tax is calculated after subtracting depreciation from the profit. But money is still with the company, right? So it is added back. Okay, for better understanding, let's take an example. Suppose you have purchased a business have purchased a machinery worth rupees 10 lakhs. Okay, and 20% depreciation is calculated on this. Now, after 1 year, will be the value of machinery? 8 lakhs, right? But where is the 2 lakhs? Has this money gone somewhere? No, na? This is with the business, right? Now you understand why businessmen don't take vehicles on their personal name, rather they take it on the company's name. All of you might have noticed that, right? If you want, I can make a separate video on depreciation. Just mention depreciation in the comments. So in formula, you have also seen interest on term loan is taken into numerator and interest in term loan is taken also in the denominator, right? Why? Because when we calculate profit after tax, that is PAT, it is calculated after subtracting the interest on term loan. Therefore, we are again adding it back, and in denominator it is taken because it is the expense that will be included in EMI, right? So before moving further, let me tell you one important point. In DSCR is always calculated on up to the projected year till when term loan repayment will finish. You have to calculate of every year, and DSCR is always taken, average DSCR is always taken into the consideration. DSCR only tells if a company can repay from its profit generated activities. Okay, so let's take an example. Suppose say Sharma Engineering Works, right? Profit after tax is 15 lakhs, depreciation 8 lakhs, interest on the term loan will be 5 lakhs, maintenance of cap expense will be 3 lakhs, and tax will be 4 lakhs. So what will be the net operating income? It is 21 lakhs, right? So now total debt service includes interest payment, all loans, principal repayment, and lease payments. So now if Sharma Engineering has total debt services 14 lakhs, okay, right? DSCR will be 21 divided by 14. Okay, simple, right? Okay, it is coming 1.5. Now what does this mean? It means for every rupee of debt service, the business generates 1.50 rupees. That is healthy, right? Okay, now let's move why DSCR matters in the credit appraisal. As a credit officer, DSCR help you access repayment capacity for term loans. It is especially important in CMA report, TV studies, project finance appraisals, restructuring proposals. DSCR is projected year-wise, typically for 5 to 7 years. In some cases, it goes up till 10, and maximum, I think it is in big industry up to 15 years. And it should be stable and above the acceptable threshold. A fluctuating DSCR raises the red flags. Bank and NBFC want to lend to the businesses they can trust to repay. Unlike collateral security, DSCR gives them confidence that your business cash flow is healthy, even if at times it gets tough. So, a DSCR means you are less likely to default. You may get loans at lower interest, right? Flexible repayment terms. In India, lenders typically look for DSCR from 1.2 to 1.4. That is the minimum ratio, right? But what is the higher? It is like 2 and above is idle, right? If your DSCR falls below the 1, the banker alarms rings, and that is obvious, your loan is not sanctioned, right? Okay, what are the factors that affect DSCR? When appraising MSME loan, remember these factors impact DSCR. Loan tenure, longer terms, means lower EMI and better DSCR, right? Because the principal repayment will be less, right? Okay. Second is assumptions. Overestimated revenue can artificially inflate DSCR. Suppose this year the turnover is 1 CR, and now after taking a loan of suppose say 25 lakhs, the company says my turnover will go by 5 CR next year. This is overestimated revenue, right? And this will definitely inflate your DSCR. So existing loans include all term loans when calculating DSCR. Most of the credit officers forget this, but since he is paying the EMI, that will be also his expenditure, right? So it must be taken into consideration, both its existing loans interest and existing loans principal repayment. Also ensure repayment starts after the moratorium. Suppose, let's take an example, you are giving a loan, in a company has applied a loan for in January, It takes 15 days for loan approval, right? And disbursement takes another 5 days. After 50 and maybe arrival of machinery take 15 to 20 days. Then installation, this covers maximum 1 month period. And now the March. Will the company be able to uh, generate income through machinery in the month of March? That financial year is finished, right? So always give the moratorium. Suppose company asks that installation will take almost 2 months or 3 months, just give them 1 month extra so that the company installed and the output increases. It will take time to sell in the market, right? Once the cash is accrued, you can easily he can pay the EMI. It will not burden him, right? So no mismatch in principal repayment and cash accruals. Also, depreciation is calculated as per tax rate, right? Always check the audit report. DSCR in your CMA report. When preparing your CMA credit monitoring arrangement report, DSCR is front and center. It shows whether your projected income will cover your future debt or not. Credit officer always closely examine your DSCR across projected years, not just the current period. They want to see the stability because volatility means risk. A consistent DSCR tells your lender you are planning for sustainable growth. That is why you are taking the term loan, because it will increase your productivity. Okay, so now next move to the magic number, that is the DSCR benchmarks. Let's consider your DSCR is above 2.0. This is the excellent zone. Major banks like SBI, HDFC, ICCI, they readily approve your loan, right? Now interest rate are at prime levels, higher loan amounts is possible, and faster processing. Everything is good, right? Now when your DSCR is between 1.5 to 2, it is good, right? Most PSU banks are comfortable. They think, okay, this is perfect, no issues. Standard interest rate, that is normally as per their benchmark. Normal processing procedure within the time frame. Now when your DSCR is between 1.25 to 1.5, alarm rings. Additional security is required. Slightly higher interest rate compared to the others. More detailed cash flows analysis needed, right? If DSCR is between 1.0 to 1.25, this is the risky zone. Loan possible but with stringent condition, and majority of the banks do not approve until you are their existing customer, a very old customer with good financials, right? Higher margins is required and additional collateral. Maybe if the margin of the term loan is 25%, but in this case bank will ask you to give up to 40%, right? Frequent monitoring is required. And DSCR, if it is below 1.0, danger zone. Banks will definitely reject. Likely no, they will definitely reject. As maybe existing facilities of yours will be reviewed and immediate attention. So now industry specific benchmarks. For manufacturing unit, bank prefer the DSCR should be more than 1.5, and for trading unit it is more due to its volatility. It should be more than 1.75. And what about service industry? That is 1.25. Predictable cash flows, right? And construction industry require more than that. That is 2.0. Your DSR should be more than 2. Project based risk, right? Understanding your industry benchmark is very much crucial, right? And this is the thing many people don't know and they make mistakes. So understand your industry benchmark, right? Now we will move to how to improve your DSCR, right? A low DSCR is not the end of the road. You can improve it with these easy actionable steps. Increase your income, boost sales, enter into new market, run campaigns, get more new orders, lower your cost, cut unnecessary expenses. Everyone knows their expenses, right? Optimize operations, repay your existing loans, lesser loan, less you have to pay, right? And that will definitely improve your DSCR. Refinance the higher interest loan. There are sometimes in need of fund. You immediately apply for loan since your existing bank is taking so much time, and they charge your bank charge you higher interest rate. Just repay them or just refinance them with your existing banker at better terms and better ROI. Every rupee saved or earned helps push your DSCR higher. Credit officer look for this attitude. They want business owners who plan ahead, right? Not who just remain in their past. So what are the common mistakes that credit officers make? They ignore existing debt in DSCR. I have seen this many times in my so many years of service. They, if they have to calculate DSCR, they always take the new loan into account. They ignore the previous one, its principal repayment or its interest repayment. They never take it. So credit officers, I advise you, kindly do not ignore the existing debt in DSCR. They take PBT instead of PAT, that is profit after tax in numerator, because they don't want to add depreciation or taxes. Just avoid it. Take the long method. Sometimes it is more helpful to calculate the exact DSCR. Choosing only 1 year DSCR without checking consistency. No, you cannot calculate the DSCR on basis of next year. You have to take the consistent DSCR, or you can say that you have to calculate average DSCR, right? Remember, DSCR is not just a number, it reflects repayment strength. Always review assumption, cash flows, and loan terms together. So, now what are the key takeaways for today's video? Let's wrap up, okay? DSCR is the most important ratio for MSME loan approval, right? I hope all of you have get what is DSCR. Why is it important? It shows your real ability to repay loan, not just assets. Credit officers rely on it, so you should consider it when planning your growth. Aim for DSCR more than 1.2. Ideally 2 or more is the best. If your DSCR is low, focus on boosting your income, reducing your costs, and repaying your existing debt, right? In your CMA report, present a stable upward DSCR path. For credit officer, please take into existing liabilities when calculating DSCR. I am saying this again and again. Always remember that, right? Always take into account average DSCR. Got it? In case of financing new companies, always take into the account moratorium period. This is very much must, or your account will go stressed and ultimately NPA. So if you have to avoid, you need to, right? Let me know in the comments. If you want a DSCR calculator or case study, just write in the comment. I will provide you. If this video helped you understand DSCR better, hit that like button, subscribe for more practical banking and financial content, and share it with your fellow bankers, credit officers, and entrepreneurs. Your journey from a banker to a confident credit analyst starts here. Until next time, keep building profitable businesses and maintaining healthy DSCR. This is Sangeeta Sharma signing off.